Good morning, everyone, and thank you so much for joining us. We are back after a 2-month hiatus for our Meet the VC event, and we have a fabulous day planned for you. We have Shruti Gandhi from Array Ventures here today to chat with you. But before we get started, just a couple quick housekeeping things as we get reacclimated back into our Meet the VC. First, I'm your host. My name is Gina Longmire. I was just telling everyone I actually started with Early Growth back in 2013, left briefly and can't leave this amazing company behind, so came back to help with some of these events. Obviously, my background is in events and most recently virtual events and running those. Today's webinar, per usual, will last about 40 to 60 minutes, depending on our question and answer. We'll try and wrap up around 1, though, to be conscious of your time. If you do have to leave, feel free. We will have this on our YouTube later with recordings, so you can always pop in, watch the end, or pass on to your friends. But throughout the day, we encourage you to ask your questions, engage. Right now, if you'd like also, feel free to chat with each other, in the chat box. Let everyone know where you're from, your company, say hi, how your week's going. We want this to be fun, interactive, and engaging. About early growth. So as many of you know, early growth is from startup to exit, your company's one-stop shop for essential business services at every stage. Obviously, from CFOs and strategic finance to accounting and human resources, we have your back office services done so you can focus on growing your business and growing your organization. Right now, you can see Early Growth has over 5,000 clients. We've also merged with Escalon, and we've now launched our And Done brand. So you can see up in the corner our new logo. And this just means that we have more capability and more resources to really help you grow your business and make it better than ever. What we deliver at Early Growth is peace of mind. We protect your profitability, and we become your partners in growth. And obviously, we would be nothing without our partners. And so here to tell you a little bit about the partners that we like working with is today's moderator, David Moore. David is an HR and employee benefits consultant who spent 4 years with Trinet before coming over to Early Growth. He's right now in finance, HR, risk consultant, and he's been with Early Growth and Escalon for less than a year. So David, I'm going to invite you to turn your camera on and pop back up.
Awesome. Thanks a lot, Gina. Appreciate it. And hi, everybody. It's nice to meet you. Like Gina said, my name is David, and I'm actually based in our LA market. And on the phone with us today, we have our partners at First Republic in Trinet. Jacqueline Seguitan is an HR and benefit consultant at Trinet. And I'll go ahead and pause real quick and let her introduce herself as well.
Hi, everyone. I also have Melissa Murad on the line. Melissa and I were fortunate. We actually worked with David in the past. We work for Trinet, and we also partner closely with Early Growth Financial. What we do is we do HR, payroll, compliance. A lot of companies right now are evaluating for Q1 to align with the fiscal year. Win-win for you as a founder, because again, aligning your books with the fiscal year when you're working with Early Growth, and for your employees, their deductibles and their out-of-pockets will match. So would love to evaluate you to see whether or not we would be a cost savings and if we could assist with compliance on HR.
Awesome. Thanks a lot, Jacqueline. And then Gina, if you want to go ahead and go to the next slide. And just so everybody knows, so Early Growth, we also do taxes as well. So not only is it strategic finance, consulting, it's also risk and HR. And then we have tax services. So if anybody needs their taxes prepared, we're offering a $500 off discount. So if you just go to earlygrowth.com/tax promo, you'll have 30 days to take advantage of that. So just wanted to share that quick promotion with you as well. And then I'll go ahead and introduce Shruti Gandhi, and she is the founder and managing partner at Array Ventures. She's the general partner wearing multiple hats. She's also a commissioner at the San Francisco Employees Retirement System. And as an engineer, she's technical and has institutional investing experience. prior to Array Ventures at True Ventures and Samsung Next Fund. She has invested in over 60 companies in their first rounds, which are now worth billions of dollars. And a lot of these companies have been acquired and had successful exits by Apple, PayPal, ServiceNow, Amazon, and many more. She was on TechCrunch 10 VCs that founders like, alongside investors from Greylock and First Round. So we're really happy that she was able to join us today. I'm going to go ahead and pass it over to her just so she can say hello and introduce herself, and then we can get started with our panel discussion.
Hi, everyone. Hi, David. Thanks for having me. Thanks for the amazing intro.
Yeah, no worries. And it looks like we've got about 40 plus people in here now. They're still kind of starting to trickle in. And would love to keep an eye on the chat to see where everybody's located, maybe the companies that they're working for and their roles. And if anybody has any questions that they'd like us to pose to Shruti, would love to get those. And so with that being said, we're really excited to talk to you, Shruti. We haven't been doing this for a while, so it's very refreshing to be able to have this conversation. And speaking on behalf of many of the founders and entrepreneurs who are on this call, there's so many things we'd like to understand about your strategy and structure of the fund that you manage and run, and your experience to really give insight to these entrepreneurs who are looking to grow their businesses, and finding funding and lending is a challenge, and you know this world so well. So to get a peek behind the curtains really means a lot. So thank you again for that. Do you mind maybe giving us a little bit of a background of the current fund that you're part of, and maybe tell us the structure and kind of the landscape of it?
Yeah. I started Array about 5 years ago. Focus for Array's enterprise and B2B, which means anything from infrastructure, cloud, security, more on the back end security side of things. We'll maybe do some application, but very differentiated applications. What I mean by application layer is more like HR tech, CRM, sales tech. Again, I'm not too interested in these categories yet, unless there is something very differentiated here. But most of our focus is on the more backend infrastructure, APIs, databases, things like that. We also are the first check in the company generally. So company has not started for a long time. They are just being formed typically. And we help from everywhere, from all the stages of like connecting them to a bank and a lawyer and folks like you guys, to back end of like actual figuring out. What we focus on is like what we call the 0, 1, 10 strategy, which is you're just starting your company, you're at ground zero, and how do you get to million ARR within a year, which is usually our focus, and then set you up for 10 million ARR. And we have various playbooks we kind of use to execute and work with our founders to get to that stage. We take board seats, and then we get off the board when there is a larger follow-on investor in a year, like an Excel or a Sequoia or someone that comes on. So we've done this successfully for 80% of our companies, and we've had follow-on rounds from all the top funds, as I mentioned, Founders Fund, Sequoia, IDP, Insight, and so forth. So that's what we're really good at, the 0, 1, 10 stage and enterprise.
Yeah, that's extremely helpful. And in terms of just your own personal, path, can you maybe tell us what it was that led you into venture in the first place, and what kind of attracts you to this industry, and maybe what excites you in terms of, your business?
Yeah. In terms of my background, I was an engineer for a decade. Started my engineering journey and had no clue about venture, honestly, but just loved building products. And I knew I wanted to start a company. So I ended up starting a company. That's when I learned more about the venture industry and what it means to start a company versus a venture-backed company. Right. Which is where I started digging in more about, let's learn how that journey is different and what it takes to build a successful, fast-paced company that IPOs within the normal realm of 9 to 12 years, which is what average enterprise SaaS company usually goes public in. And it's a very different journey than just kind of growing slowly, bootstrapping, not taking investors and things like that. So as I spend a lot of time learning about this, I decided to get into the venture journey to learn all that. And then, the idea was to go then maybe start another company after that. But I ended up working at Samsung Corporate Ventures, and then True Ventures. And then as I was spinning out to go start a company, that company ended up becoming Array, which is my fund. Because a lot of the people I had been working with over the years at Samsung and True and others had basically said that, they loved working with a technical investor like me. Very few people at the pre-seed first check stages are very technical and invest in the kinds of categories of, that I talked about, which is enterprise, databases, security, cloud, infrastructure, things like that. And so they said, having me on the cap table was really valuable for them. And that's kind of, that made them want to invest in me, which I didn't know what that meant at the time. But they said, if you're starting a fund, we would love to invest in you. So that was the early days. My first fund was most of my founders I'd been working with. And here we are on our third fund now.
Oh, that's wonderful. And, in terms of just the current fund and how you source different companies to invest in. I know that you mentioned enterprise software, SaaS. Do you find value in researching companies that are outside of these different verticals? Would you say that you're more of could be more of a generalist fund, or you're just focused on a specific sector? How do you feel about exploring other industries?
We're an enterprise fund, B2B fund, that's a generalist enough, but we don't do consumer. So that's taking away like half of the category of companies we don't do. But within enterprise, we're generalist, meaning, again, as I mentioned, we do anything crowd, infrastructure, security, and if we do application, it's very picky. So it's not exactly what we're looking for.
Would you attribute that to your technical experience and just being very comfortable with that and knowing it so well from your experience that it helps you evaluate these opportunities? Or is it purely ROI, or what would you kind of attribute that to?
Both. I think ROI, expertise, and also that application layer is very crowded. To start a company in HR tech, talent acquisition, CRM, I mean, you really are, you really have to, I get one pitch a week on onboarding, employee happiness, employee productivity. These are categories that most people end up starting companies in on the application side that is just not differentiated. So for those market dynamics kind of reasons, we've decided to kind of shift into what we know best, which other investors can do well, which is invest in tech heavy companies.
That makes a lot of sense. Well, and you said that you're typically the first check for these companies. What would you say the typical investment size is that you're making, and how involved are you with your portfolio companies?
So I'll start with the involved. I mentioned we are involved. We help our companies from the 0, 1, 10 journey, and we take board seat. We help them get there. Obviously, the founders are very smart. They don't need me, but what they need me for is doing things that they haven't done before. Sometimes they're repeat founders, and 4 or 5 years later, when you're starting a new company, it's often a new journey. World's changed, and so the go-to-market piece is new. So that's where we're very helpful. Just helping you plan that 0, 1, 10 journey. And the check size, we like the rounds to be anywhere from less than to $2.5 million. And we put in about 1.5 on an average.
Mhm. And do you, I know that you said that you take on a board seat and you're actively involved with your portfolio companies. Do you also lead subsequent rounds or fill out rounds or co-investing or anything like that? Or how do you support in terms of, raising funds for the next round?
No, we do not lead the next round. We are the first check investor, and
Mhm.
we help our founders, as I mentioned, get more money from smarter people than me for the 10+ million stage, which is
Mhm.
folks like the Excels and the Sequoias and the Norvests and the IVPs of the world.
Mhm.
So I've been in venture for a decade now, and that really, is the relationships at those places, partners, firms, is why we've been able to have such success for our founders get follow-on rounds.
Yeah. Well, and what about the due diligence process for you? Can you maybe tell us a little bit more about how you evaluate these opportunities and what you like to see before you decide to move forward?
Um, we are very thesis driven. So oftentimes before the first meeting, even I know what I'm looking to invest in. Usually I know what approach I want the founders to be taking, or I
Mhm.
want them to tell me why the approach they're taking is much different than anyone else. So we look for a lot of differentiation, moat, uh, founder expertise in the space they're solving problems in, and then technical expertise for them to be able to build a product.
Mhm.
Um, that's what we really look for. And at our stage, there's no product per se. It's just what I mentioned. It's a talk of how we're going to build products. So we nerd out on like, what the product is going to look like and how we can go build it together. What stack are they going to use, right? Like those are the kinds of conversations we have in the early days.
Mhm.
And that's what gets us excited into why we go lead an investment in a particular company.
Mhm. Are there any are there any pet peeves that maybe you could share with us? I know you just said you get about a pitch a week, and it sounds
No, I
like.
don't get a pitch a week. I get a pitch a week on a topic, is the topics I mentioned.
Oh, okay. And well, with all of these pitches, are there any pet peeves that you see or get when you're evaluating?
No, I wouldn't say there's pet peeves more than just founders don't really, it's kind of hard because founders don't really know the process.
Mhm.
Sometimes if they haven't done it, and if they haven't done it before, it sounds like, like entering a new world. Uh,
Mhm.
and I would say that when you're emailing cold to someone like me, just make it brief. Talk about your metrics fast. Talk about how much you've raised. And by the way, I tweet about all this a lot, and I have a Substack newsletter on this as well. So I would follow me. It's Shruti Gandhi .substack.com, or on Twitter, which is @Shruti, or on LinkedIn. I'm usually very transparent about everything. And one of the things I've talked about is how to do cold inbound.
Mhm.
And it's important because I think otherwise you're kind of in the dark. So I would
Mhm.
follow some good people who talk about it, are very vocal about these things, and kind of try to learn as fast as you can. The pet peeve is not that you didn't do it right. The pet peeve is more like you didn't do your homework, I guess.
Mhm.
And sometimes the emails go long, or
Mhm.
they're not focused,
Mhm.
or they haven't done homework on who they're reaching out to, or they're like, it's not a firm and a company that's your fit, but introduce me to people, like, which is kind of really odd. Like, how many times have you gone out of your way to introduce people to, other people when you've never met them?
Yeah.
Which is
Intense.
very rare, but people expect that out of investors somehow. So I don't know. That's not a pet peeve per se, but it's just like lack of
Negative.
experience sometimes
Mhm.
in the industry, venture industry. But yeah.
Well, and I was going to say, is there any advice that you could give some of the early stage founders that are on this call when they are trying to find an investor to work with? And, I guess one of the takeaways would be do your homework. So just know exactly who it is that you're reaching out to. But when you say do your homework, what specifically should they be looking at?
Stage fit areas that the investors invest in, competitive companies. Um, yeah, and then a lot of the investors these days are pretty vocal out there. They're pretty, like someone like me, I'm pretty open about what I'm looking for, not looking for, best practices. If you haven't gone on Twitter to kind of learn that, then that's not the homework. You have not done that homework. At the very least, follow, see the last 10 tweets, get a sense of the investor.
How would you just, and more, macro speaking, and just working with the venture community in general, how would you articulate the different stages and funds and how they're set up and what their expectations are in terms of ROI and exit? Is it typically early stage investors want to see a certain business objective attained within 12 months, 5 years? What's the return that they typically want to see, and how that landscape is in just the investment community at a high level? How can you talk about that a little bit?
Yeah, I think I started out by saying that venture journey is different. You're expected to have different, like, particular milestones every year. The growth, which, I mean, as you guys probably help your founders think through, which is, you have to have 3 to 5x kind of growth in the early days. It is really hard. And when I say 3 to 5x, I don't mean like $100 to $300, right? Like, first you have to get to $1 million ARR, which should not take more than 1 to 2 years, right? And then after you get to that, you have to then grow 3 to 5x, which is 3 million, 5 million, things like that. And you have to keep doing that for a few years. And you have to carve out your journey to 100 million, which is the most important milestone. I'll tell you why. I mean, this is pretty common knowledge at this point, but larger funds that I mentioned, everyone from like an Andreessen, Greylock, everyone else, have $1 billion funds, billion plus. And I think at this point, they have $2-3 billion plus funds. For them to make a return of, usually you have to return like 3 to 5x minimum. Now, how do you make, 1 billion go to 3 billion and 5 billion? By investing in companies that can be valued that way. So now if you take a step back, they have to, and in venture math, generally 1 or 2 of your portfolio companies return the whole fund. That's just an industry called power law. Now, if you're talking power law, and if you're talking 1 or 2 companies in $1 billion fund, helping that fund get to 3 to 5 billion, well, if you work backwards on what that looks like, that company has to have a particular kind of revenue to get there. And the most minimum for that kind of milestone is 100 million in revenue. Because if you're 100 million in revenue, you get to be worth maybe 10x at least, which is $1 billion in valuation. So that's the math, venture math for you. And now if you have to get to 100 million in revenue, your growth has to add up to that. So when you start out, and if you don't get to $1 million ARR within 1-2 years, and you're already falling behind, is what I'm trying to say. Like, because from 1, you have to get to 10 to 50 to 100. It takes an average, it takes anywhere from 6-7 plus years to get to that kind of a milestone to 100 million ARR. And that's just when the journey begins, because that's the baseline for a lot of these funds. Remember, I told you they need to return 3 to 5 billion minimum, and for it to be a good fund. So if that's the case, you were just still valued at $1 billion with 100 million ARR. So you have to keep going. And that's the craziness of the market. Now, there are other dynamics today. There's revenue, there's engagement. Like, there's companies like Figma and early days Slack and others who had very different kind of numbers on engagement and usage, daily usage of the product. But that's rare. That kind of network effects and virality is very rare. And that's what a lot of founders bank on for some reason. But that makes it look like a consumer company. And that's kind of hard to kind of get those kinds of metrics in the early days. So anyway, I hope that's helpful kind of framework.
No, very helpful. And just to kind of maybe elaborate a little bit on the due diligence piece for the founders and entrepreneurs, it's important that a financial model and business model is built out to share with a potential investor. One thing that I would be curious to understand is if you see potential in an opportunity. How involved do you get in helping them build out the financial model if that's not necessarily their strong suit? Maybe they have conceptually a great idea and product and something that can, address, a market need, and you see the value, but the financial model or the business model isn't up to par. Do you typically ask them to go out and find other resources to do that, or is that something that your firm would help with?
I don't know what a financial model, most firms don't have a financial model, companies don't have a financial model at my stage. That's not what we're talking about. I don't think I need companies to just like randomly say we're going to be at 3 million in 2 years or something like that. That's not what we're talking about. The business model has to kind of talk about that. And that founders are usually generally good at. They just need help figuring out a few other little tweaks here and there. So we're pretty involved on business model side, non-financial model side. I mean, that's what you guys are here for.
Correct. Yes. Shameless plug. So from a business model standpoint, they usually have that ironed out, but you would support them in sophisticating it essentially.
Yeah.
Yeah, that makes a lot of sense. And just out of curiosity, how has the pandemic affected the investment process for you, if at all?
It's just more speed. Rounds are getting done faster. When I say faster, like in a week. So, I think tech has really survived the pandemic, and especially enterprise has really survived the pandemic. And companies are getting valued higher. Rounds are getting done sooner. And so you're always on as a VC, you're always kind of trying to stay on top of things because it's easy to just lose an email and not respond for a couple of days. And by the time you follow up, something's kind of already done. So, yeah. And so I think just like everyone else, investors are really busy just trying to chase the best next founder to work with. And I think, don't take anyone personally if they don't respond to you. I think that just may not be the right fit for you or whatever it is. Founders have gotten more clever about follow on, but I think, just maybe stop after 3 or 4 times. I think, I don't know if there's if you don't hear back from someone, it's just not the right fit,
Well, and in considering how early stage these companies are that you're evaluating and working with, at what point in the relationship do you find it's appropriate to suggest, personnel changes or bringing on an executive to maybe take on a role that one of the founders was doing? Could you maybe talk about that kind of influence a little bit in what you see at the seed stage versus Series A, and kind of influencing the leadership component and starting to grow the team, and when it's appropriate to advocate for that?
Honestly, a good board member does that at any stage. So when we make an investment, sometimes we're also telling the company to beef up certain parts of the company right away. What their first few hires should be. Now, founders may have a different perspective, and we work with the founders. As I said, founders are also very smart. The kinds of founders we invest in, have been either founders before or had been, successful C-level or executives at other large popular companies. So it's not like they don't know what they're doing. But it's our job as board members and investors to push them. And so that's the kind of investor you're looking for, who can work with you and you can work with them to kind of be transparent, honest, have a relationship where you can go build a big company together and not be afraid of getting on that call with that investor, which I don't want that kind of founder either. So it's mutually appropriate to pass on all those people.
Well, and on that note, I mean, in terms of just challenges for you in managing your fund, can you maybe talk a little bit about the challenges that you face regularly managing your fund? And I would assume that would be one of them, is having those types of relationships with a portfolio company.
That is not that common. Usually rare. In my 10 years, it's like maybe twice.
Mhm.
And it's mismanagement of expectations or styles. And so that, yeah, it's but usually not that common, honestly. I think, you spend enough time with the founders and you're all on the same side. Generally at this stage, there's not much friction usually at this stage. It's not like a show Shark Tank or something. It's not like that at all, right? It's like you're on the same side building the same thing. And everyone's smart. I keep repeating, everyone's smart, everyone's, knowledgeable. So I think it's a idea of making sure that your best comes out with the right people. And and then founders who can't take it should not be funded by me anyway. So that gets weeded out pretty early on.
Well, and where do you typically find that? Where do you find these founders and startups that attract you? Because you have a lot of inbound coming in and a lot of outreach to you, but where do you find the most success in finding these companies?
We have angel networks that we work very closely with. These are experts angels who have invested in our fund. So operators at big companies, again, who are super valuable to our founders and me. So oftentimes they're looking at a deal, but they're going to be a small check, and they oftentimes work with someone like me to price things, be a lead investor, be more involved, things like that. So that's like a big source for us of deals.
Yeah, well, and it's interesting to hear, where you're sourcing these companies, because a lot of founders that are even hiring early growth to put together their pitch decks or put together their financial models to get them prepared for the due diligence phase. Can you maybe tell us what they need to have, what you'd like to see have ready to go, technically speaking, that would speed that process up for you? What do you typically want to see right away?
That they've worked in that space before, which you can't just create overnight. If you're solving a DevOps problem, you should have DevOps experience, right? So I don't think there's anything I'm looking for in anything. I mean, usually founders have nothing at the stage when they're talking to us. So other than their experience and their unique insight as to why they want to go solve the problem. So not much.
And then in terms of the fund that you currently have, just out of curiosity, how much of the fund do you typically reserve for future rounds? And how much of that is currently remaining? Just to kind of get an idea of your own outlook for the next 12 to 18 months and how you see yourself going about investing in companies. Do you have a target amount of companies that you'd like to invest in over the next 12 to 18 months? And what does that look like?
Due to some SEC regulations, I can't talk a whole lot about our current fund. But we do on an average 10 checks a year. So this year I'm about 2 more companies away from 10 in 10-ish investments, and then we'll do the same next year. And we, as I said, are the first check investor, so the follow-ons don't come out of the fund, but we usually follow on in 40% of our series are not series A, like just 40% of our total portfolio companies from each fund.
I see. Well, that's very helpful. And I want to be respectful of your time and the participants to see if anybody wants to ask any questions, but we have about 20 minutes left. And so I just wanted to open it up to the audience to see if anybody had any questions for Shruti specifically. So feel free to unmute yourself and chime in. Does anybody have anything that they'd like to ask?
I can help. There were some that came through. One was, what are the challenges in managing a fund, facing investors, finding the right startups to invest in? What's the common strategy in resolving these issues in those areas?
Strategy for resolving issues. I don't think those are issues. Those are just things you have to do. You have to fundraise, you have to deploy. Common challenges are just that you're wearing multiple hats as an investor, especially if you're running a fund. I think I joke that you're at a given second thinking about 6 things to work on. And that goes from LP management, fundraising, sourcing, deploying, managing your portfolio companies, and marketing, all of the above. And it's not a glamorous job. You know, people assume that you're like on panels like this all day long, but it's actually not that easy to run a fund, and it's also not in the near term monetarily sufficient. As you don't get paid that well to be in this job, because the math is very straightforward. The amount of money you have to run a fund is predefined based on the capital you've raised, and now you have to do a whole lot of this other work. And there's a very limited number of people you can pay. So what you're working hard on is for the upside you can get from these companies, which if this company becomes, 10 million to $1 billion in 4 years, which is a lot of our companies have gotten to those through that journey, they're valued at $1 billion in 3 or 4 years. That's great. And it's even better if they're actually getting to those journeys and then getting, going public, getting acquired. That's when you make money, because once you return the fund, right? First, you have to return the fund, which is, let's just say, like in layman terms, you have to return the principal of your capital. So if you return the fund, so let's say your fund is 100 million, you have to return at least 100 million before you can even think about getting paid, which is called a carry. Mm-hmm. So some of the things you are optimizing for is, how do I get that kind of payout fast? So when I start getting paid, and two, the investors start getting paid. The investors are not in it to just get $100, 100 million back. I mean, that's like getting your principal back with no interest in for 7 years. So that's not their goal. They can go invest in public market. Now imagine public markets. Public markets, on average, they say like return 7%. So you have to do better than that. So if you're a $100 million fund and you're just returning maybe even 200 million year 7, you did poor compared to S&P 500 or something. I mean, the investor and LPs are better off putting that money in the public markets, especially today when the public markets are going crazy, or even crypto. So I would say that the math, again, the type of companies that you have to invest in has to be a fit for a fund, which is the homework I'm telling founders to do. Like, if you're not going to be on this trajectory, don't take this money from certain kind of investors. And if you're not a fit for a particular kind of fund, if you're not a stage fit, just do that homework, because you want to save your time and maximize your opportunity. If you're going to talk to 100 people, 100 investors to go raise money, make sure that those 100 investors are worth your time and their time.
Mm-hmm. That makes a lot of sense. It looks like Moon Chu has their hand raised. Moon, did you want to ask Shruti a question?
So it looks like Moon's question is, what is the number one intangible quality you look for in a founder?
I like hustlers. I like people who are like their ability to close deals. Oftentimes, like, I find people unable to even make fast decisions. They go in circles. And those are the founders I like to avoid. It's a personal thing. But for me, I believe if two people want to get into business, there has to be, at our stage, the stage I invest in. Again, later stage is a different story. But at our stage, which is first check stage, it's all about the gut and how you feel. And you're not going to have enough data at all. like what kind of data are you, I mean, you can talk to a few other founders and so forth, but that's not what I mean. Like, it's like the ability to believe in the investor and be aligned on the vision. But I think founders oftentimes go in circles, try to get an optimized for the best price. I mean, I'm not talking about like, predatory terms like giving up 7 to 10% of your company for 100K, none of that. I'm talking about like, if you have apples to apples comparison, you have a term sheet from 2-3 smart investors, go for someone that you're aligned with. And that's the kind of founder I respect as well.
Mhm. Well, and you brought up an interesting point around almost like predatory investment in lending, and for a founder who's never had experience raising funds before, but knows that they need capital in order to scale their business, but this isn't their strong suit. What advice would you give them when they're evaluating relationships with investors to protect themselves from doing something that might hurt them in the long run and entering into a poor arrangement that maybe they didn't foresee happening? Is that something that you can maybe talk to a little bit on the entrepreneur side, what they should be looking for to protect themselves and take care of the company?
Yeah, I have a strong opinion on this. I don't really think you should start a company if you don't think you can fundraise. And I think accelerators, there are a ton of them, but I would only go into maybe Y Combinator for those kinds of terms. Every other accelerator is, in my books, not really relevant.
Why?
So, I mean, I don't even know what they do, like, other than just put you through some program and take 7%. And most of the companies come out of there looking the same. Anyway.
Do you find that those companies that leave accelerators who haven't actually taken capital from anybody have a poor term sheet or deal with them, and then they come to you, and that can hinder your deal with them?
Well, that's exactly why I told you we're first check investors. So we invest when the companies are being formed. We don't invest out of these accelerators for that reason, because expectation is after this round, even if you don't have made, even if you haven't made enough progress, you're now expecting valuations that are crazy, that don't match up your progress, just because you now have diluted yourself and you feel like you shouldn't dilute yourself. But the dilution in the first place is a bad idea. Giving up someone 7+% for 3 months of, I don't know, friendships with other founders is not someone I back. So we have a very different playbook, and our playbook requires you're just starting from basically nothing, or you haven't taken money, or you've taken 100, 200, 500K just from like angels at normal terms, not from accelerator.
So maybe to kind of bottom line, the way that a founder could insulate themselves would be to just do their due diligence on these accelerator programs and just make sure that they're really going to get the value that they're saying they're going to deliver, which I know you have an opinion is probably not a ton of value, but a lot of these companies are part of these cohorts, and these accelerator programs are so popular. So just kind of, it's interesting to hear your take on that. So do
the homework on how many companies. I mean, they'll always talk about like the 2, 3, 5 that were breakouts, but talk about how many actually ended up raising good follow-on rounds, what they're now, like, what do they actually do after to really help you raise your target capital that you want to raise. Yeah, it just doesn't make any sense to me personally, but everyone's different. I mean, I was a founder, not a founder of the fund, but of a company 10 years ago. I've been in the shoes of these people. I think the problem is once you give up all this company and then you're on this hamster wheel of raising money little by little on multiple safe notes, that's not a glamorous journey. It's not. It's just like not what you should be doing. Like just again, to start a venture-backed company. Because you're already starting on the wrong footing of the growth I'm talking about, of what really gets funded today. And you may break out, and because of your on your own will, not because of the accelerator you were part of, on your own will. That is, then why not just start there? Believe in yourself. Don't give up so much. Yeah. And today, again, if you are a founder who can't raise money, that's unfortunate. I mean, like today, there are a lot of diverse investors like myself, women investors, people of color. Reach out to them. Don't, I think market's changing. It doesn't like, and these accelerators are also not taking those diverse founders anyway. So it's like kind of crazy where you end up with that kind of dilution. But again, everyone has to make their own decision. As I said, I have a strong opinion on this. Other investors don't. There are many investors who invest out of these accelerator companies. So again, do your homework. If you reach out to me, you're probably going to hear a no. But that's the part, like if you listen to a chat like this somewhere that you're going to put up on YouTube, and then you get a sense of the kind of investor you're going for, and that would be the right investor for you.
Mm-hmm. That's very helpful, and I appreciate your insight. One of the questions that I got was, in starting your fund, you mentioned that angel investors made an investment. Is that the route that most people take when raising a fund like Array Ventures?
There is no one route. If you think it's hard to raise money for a company, it's even harder to raise money for a fund. Because for a company, it's very clear. Sometimes people believe in what you're solving or not. It's binary. And then it's all about like your ability to execute that. But in a fund, you're saying, this is my strategy. It's blind. So I invest in enterprise companies. And by the way, if I'm starting my first fund, you better believe I invest in an enterprise company, because this is my first time running a fund doing that, right? Mm-hmm. So hopefully my track record has added up to that. Or if I don't have a track record, then just believe me. And then invest in the next, where I will deploy the capital for the next 2-3 years. You're not going to get money back for a long time. And hopefully I'm able to return. I have the right expertise to run a fund and not just be like and so be a good picker, be a good fund manager, all this other stuff to return 3 to 5x minimum. And at the funds that are our stage and size, it's like even 10x. We're targeting larger returns. So yeah, so it's like a really hard thing to tell investors to blindly invest in your fund without much. And people of color, women have the same issues and problems raising funds as they do when you go start a company. So now, what kind of investor can you attract is the most important question. Who believes in you? Our first fund was all my founders who I'd worked with before, basically. And that's the most important thing. They knew me, they'd worked with me, I'd made money for them, they'd made money for me. So that's what this industry sometimes ends up being, to give a chance to someone like me, who wouldn't have gotten a chance ever before. Someone like an immigrant like me who came with no money 20 years ago, taught myself how to code, no expertise in venture, did not have a chance, did not go to the right schools, did not go to Harvard, Stanford, did not have a chance to be doing the job I do, which is what less than 1% of the people do. And even then, you don't make money till you actually return money. And that doesn't happen for most people for like 7 to 10 plus years.
Well, and you're in a space that isn't very diverse, and is, we have this conversation a lot around, diversity and inclusion, and even just, it sounds like one of the motivators that you have as an investor is to give those opportunities to people who don't have the same access or representation or experience, or don't fit that kind of traditional look. And so maybe just on a personal note, what is it like being in such a crowded space where, you are, kind of an underlier, an outlier a little bit in a sense? What's that like?
It's great because the thing is, people in venture talk about patterns, and the patterns they're used to is a Stanford dropout, young white male, from the best AI lab, and just throwing money at them. That's not our pattern, right? My pattern is to find people that I can see who don't talk the same way, who don't have the same confidence that other funds might be looking for, who just can speak differently, and they don't, but still be okay, because I'm not looking for those signals. And that's why we have a third of our founders are women founders, over 70% of our founders are immigrants. And in enterprise, people say that's really hard to do, because even less in the industry, less than 2% of the founders are women. But when you talk about enterprise companies, which is more technical, more infrastructure, cloud, like, we have way more, founders that do well, especially diverse founders that have done well. So I think when we look for those signals, I'm sure I have my own biases, right? Like we all do, we're born with them. But currently to your question, the patterns I look for are different. And that's why we're able to invest in such amazing founders who look like not winners to other founders, other fund managers, but to me, they look like winners, and then they are winners. I mean, I told you, we have at least 4 companies that are worth $1 billion in less than 4 years. And that those are people others have not invested in, and we've consistently backed. So, that there you go.
Yeah, well, and it's also just rewarding, and on behalf of the group too, which a lot of people have, expressed their appreciation for the candid discussion and, your insights. And, you can tell that they are very genuine and rooted in that, a meaningful approach. So on behalf of everybody, thank you so much for giving us that insight. It's really great. And I, again, just want to be cognizant of your time. I know that we just have a couple more minutes left. So 2 minutes left here. Looks like people want to get in touch with you after the discussion. Do you mind maybe putting in the chat or just giving us a little shout out now, the best way to reach you?
Yeah, the best way to reach me is, I can also put in here, is on Twitter, which is let me just find my handle quickly. So then here you go. It says everyone, there you go. There you go. My LinkedIn is also, feel free to follow me on LinkedIn. And usually I see a lot of questions here about the kinds of deals. I just want to reiterate, we're enterprise fund, first check investor. We only do deals like infrastructure, cloud, security, more tech heavy founders, companies that are just being formed, and mostly US markets. So just kind of a lot of the questions around other areas. We don't do consumer, we don't do full on hardware. We like data, AI, ML kind of companies. So it's very narrow set of companies within enterprise. And if it's a SaaS, happy to take a look, but only for differentiated SaaS kind of companies as well. So
super helpful. Awesome. Well, thank you so much again, Shruti. Truly appreciate it. With that being said, everybody take a look at the chat. You've got Shruti's Twitter link and her LinkedIn directly, and we'll send up a follow-up note to everybody who's on the chat. And so again, thank you so much, Shruti. We really appreciate it.
Yeah, and thank you too, David. So thank you, Shruti. Thank you, David. And we look forward to seeing everyone next month as well. So remember, second Wednesday of every month, you can find out more information on the website and register for the webinars there. And make sure you follow Shruti and reach out, and David as well. So thank you all so much, and enjoy your Wednesday.
Yeah, thank you for the amazing questions. This was, time flew by, and thank you for having me, guys.
Thank you for being here. We really appreciate it.
Awesome.
All right. Bye, everyone. Have a great day.
Bye, everybody.
Bye.